Welcome, guys, as you're coming on. So my mic was on mute for a minute, but I'm going to give you guys a chance to just come in. Let me know what you're looking at. I know the market's been very, very funny to talk about in a moment. I'll use it as part of the teaching about market monopoly. And then after we can, have a discussion. So I'm going to give like 1 or 2 minutes for you guys to get in. And then after we can take it from there. Yeah. So we'll start soon. I'll give you about 2 or 3 minutes. Okay, people, so I wanted to record this session so I can keep it as well. Make sure that the live feed is stable, just in case if the live feed was to cut off, I can still be recording. Thought that'd be a good idea, just in case I say something or some of it gets cut off, I can just replace it with this video. So welcome to session 3 or episode 3 of this series about institutional trading. And I'm of course going to spend the time today to go through a bit of what the market is doing. So I might do in reverse order. I'm going to teach for a little bit and then after go straight to the charts and then we can look at what's actually going on. Okay, because it has been a very funny day. And if you are on the wrong side of the market, I'm sure you'll probably be very sad. If you go into the early entries that I've given you, then you should be absolutely fine. You just have a little bit of, well, you're going to have to wait a little bit more, but you still should have profit from all the trades that are going on. Okay, if you don't, then that would be something that we need to fix. All right. But nonetheless, anyway, it's been a very funny day, interesting day. So many strange things have happened in the market. As you guys can see, the market has been very mean to everyone. Okay. And I'm not surprised that the market would do this on such a day because really and truly, everybody probably is too many traders are in profit and they don't like that, which is why the market has crashed around. Now, if you're listening to this record and you have no idea what I'm talking about, it's okay. By the time you finish this series, you should understand what I'm talking about. So let's begin now. Going back to what we were talking about in the previous sessions, we were talking about market monopoly. We're looking at price structures and things of that nature. Okay. And we looked at accumulation, we've looked at order blocks and order books, the market order book itself, how it works. We will be going through, a few of the different structures of how price works. I want you guys to take the time to go through the videos that I give you because they all do have meaning. Every single lesson has meaning when I give it to you. And I don't say anything or I try my best not to say anything that is not necessary to say. Okay. So I would like to make sure that you guys have all the teaching that you need to have a foundational grasp and understand that the market is not designed to be your friend. So if you treat it like a friend, you're going to be very unpleasantly surprised about how it treats you. Okay. And that's how it is when it comes to price action, to the market, how it works. And I think a great example of how the market is not your friend is today. I think today the market has been the most unfriendly in quite a while. And I know that a lot of you are probably feeling it and you are feeling annoyed because some of the trades that is in the right direction has basically been doing the same thing over and over and over and over and over again today, at least for about 4 or 5 hours. I know for myself, even though I understand exactly what's going on, it still is annoying, don't get it wrong. It still can take a toll on your head and you might want to even come out of true position sometimes because you just can't stand this back and forth swinging action that the market is doing. But if you read the price really well, then you know that all that the market is trying to do is trying to phase out the weak ones and keep the strong ones. Or if you're over risked or something like that, try to get you out by margin call or something like that. So this is the story of what's been going on. Okay. Now, I do like the price action though on the market. I still think the price is really good for trading and getting great profit out of the market. But of course, we just have to be a little bit careful of how we proceed in doing that. So that's my focus really today, to kind of use what's happened today with the market to teach about market monopoly and what that even means. Now, by the design of, the picture that I put, I always like to use pictures to say 1,000 words, if you want to put it that way. So I always like to let my images, bring a picture, of what I'm trying to say. So in this case, with the picture that's on the screen, before I start any teaching, you can see that I have a monopoly board. And the market is a lot like a monopoly game. Okay, there's the rich ones who are trying to get richer and the poor ones who are trying to get richer, but they just seem to think they know how to get richer, but they don't exactly know what to do when it comes to charts. All right. Now, I speak to traders all the time. I try to make sure on purpose that I speak to different traders from different backgrounds to kind of understand what trades are they in, why did they get in, what were they looking for, just to kind of have like a mental survey in my head. This is what I like to do. Just have a mental survey of, what exactly is going on. Now, you may hear my alarms going off because I have trade alerts set for certain areas because I just want to observe the price in certain parts of the market and just see how it's behaving. So if you hear an alarm go off, it's not the fire alarm at all. It's just my trading alarm. All right. So looking at the price action anyway, when it comes to market monopoly, let's build a new picture again. All right. Now, remember to understand market monopoly, and I'm going to put this over here. First of all, let me just clear this chart. So Control B, Control A, delete all of that. Let's just start from the beginning again. In the sense that let's just go for some definitions. So first of all, market monopoly. Let's put this here. Let's put this as size 14. So with market monopoly, for you to understand the definition before I give it to you, what are the things that are prerequisites that you need to have in mind? Number one, all price points in the market are engineered. Okay, I'm going to put this over here. Maybe we can make it a bit bigger. By market participants with more money than all retail traders. Now I'm trying to use simpler terms instead of using complex terms. So I've got here, all price points in the market are engineered by market participants with more money than all retail traders, okay, put together, okay? So that's a prerequisite to understand what market monopoly is. Now, I don't know what I've just done there. Change this, participants with more money than all retail traders put together. Now, I think there's different anatomies that you can have. There's the anatomy of price delivery mechanism. There's the anatomy of a candlestick, which is another form of anatomy. Let me just do something here. All retail traders put together. So now sometimes when I use the word anatomy, it sounds like we're switching from trading to biology, but it's still within the same context of what we're going for, okay? So all the price points in the market are engineered by market participants with more money than all real traders all the retail traders together. What that means, I try to keep it as simple as I can, is that if all the traders were to press the buy button on the market right now, it would have no effect if a market participant from institutional or governmental money press the opposite side and put a sell down. All of the positions that we have will be in a negative because they have infinitely more money than us by default. Now, I want to bring up an old graph that I made. Let me see if I can pull up this graph for you guys. I should have it here. If it's not here, I'll make another one. Okay, it's not really a big problem. I'm trying to see if I do have it. If I don't have it, it's fine. Okay, it doesn't look like I can see that right now, but nonetheless, it's okay. Let's just continue moving and I'll come back and draw it. Now, with this point number one, you need to have this as a foundation to even believe market monopoly is even possible. Okay, as I said to you, from my background, I thought that the price was controlled by, me and you, by retail traders. As we talked about in the first session about accumulation, I was always taught that consolidation or accumulation, the usual term is consolidation, is that when the market is in a range, what that means is that the number of buyers and sellers are equal, so the price doesn't go anywhere. So there's kind of like a mastermind situation going on where one side, whoever has the most buys or sells and chooses the right direction, that's the way the market will go. Another term that they used to say, which was, now that I understand where I stand, was just absolutely bogus. And people were selling courses for 5,000 doing that, was saying that the market was indecisive. So the second point I want to say to you is that the market price is never indecisive. Or let's make it a bit simpler. Never in any form of indecision. Okay, so there used to be a term in trading, old school trading, which was the term indecision, which means they're saying that the market is in indecisive place at the moment. The market doesn't know what it wants to do, whether it wants to go long or short. And that's the reason why the price is in a range. Really, really bad teaching, because what that was assuming was that the price itself is controlled by us, or is controlled by people, or is managed by people. But these people are not too sure what to do. They don't know whether Euro USD should be higher or lower. Now, unfortunately, that was such bad teaching, but I really did believe that. So whenever I saw a range, I'll either try to trade it or I'll just leave it alone. I wouldn't be observing it for anything to see if anything happens. When I noticed the price goes out of a range, I didn't understand the mechanism of how a price breaks out from a range into a trend, or from accumulation to an expansion. I had no idea how that happened. All I knew is that, oh, the price is not ranging anymore. It looks like the price is going bullish. Okay, let me place a buy somewhere in the middle of this trend and continue going. That was really my thing, and plus at that time I was trading binary options as well. So trading binary options, my mind wasn't, I was thinking about trends, but my mind wasn't really heavily geared towards understanding price mechanics. I was just trying to make sure that my trade was above or below a certain price within 30, 60, 1 minute, 5 minute, seconds, etc. That was really my thing, basically. All right. And that's how binary options, that's how my kind of story into trading, binary options. That was my first ever, insight, Now, I knew about Forex. If you're wondering the question, I did know about Forex, but from how people made it, it seemed so complex that I was scared to get involved, especially with doing a stop loss and stuff. I didn't want to get involved with doing it. When I received my mentorship the first time from my mentor, I was actually working PR for him at the time. That's the first time that I switched from Forex, into Forex from binary options. Now imagine I was having some sort of success. I had a strategy that had I'll say like a 55% win rate. Very simple strategy. I was using Bollinger Bands and RSIs, and I was just looking for the price to come out of a certain range to look for a trade back in within the range. That's all I was really looking for, that kind of scalping technique, if you want to call it that. So with that technique in mind that I had, that was my way of trying to find out what to do in terms of taking a trade. And that's all I was basically doing. And I was going to set off on that and start a business and really go out there to the world and say, hey, this is my strategy that I have, which I'm glad I got at the right time, because I could have caused a lot of damage. Now, fast forwarding, looking back at that time, I'm just so glad that I was managed to understand the things I do understand. And I realized that this point number 2, the market is never in any form of indecision. It's a lie. Okay. So one of the things with market manipulation or institutional price action that's important, apart from all the complex things we could say, is that you need to change your belief system. That's the first thing, because the belief about the market is one of the reasons why institutional money and governmental money have a leg up in the market. Okay, they use different things, and I'm going to go through the different mechanisms that they use. Okay, so let's go through. All right, trading, I'll say belief mechanisms. All right, so the belief mechanisms here, if I go through a few before I come back to the next point, we've got the first one, which is fear. Okay, fear of missing out. It's fear in general, but the key word is fear of missing out, which is FOMO. Okay, the price delivery mechanism that we looked at in day 1 and day 2 is designed to create this scenario of fear of missing out. Okay, this is one of the major ways that things like fear of missing out is created in the market by these people, because they want to get traders to act out of emotion. Okay, act out of emotion so that they can act with intelligence and take your money. That's really the plan. Okay, so for that to happen, in order for you to get into a position where the market does such a thing, you do need to have these beliefs in mind. So fear of missing out. Okay, if I go over to the next one here, let's type it out. And it is greed as the second one, because you're probably saying it is greed. Okay, greed. Now, the belief mechanisms that come from some of the lies that I'm trying to debunk already is what powers greed and fear. Okay, things like the market is really, that kind of belief that the traders around the world, retail traders, are what are causing the market's price to really move. And that can make you greedy, because you can think, okay, there's several ways you can go. I remember when I was trading binary options, they used to have this small little indicator that will tell you how many people are buying and how many people are selling. So I thought I was a smart person, and I thought, okay, when I see maybe 80% of people buying, I'm going to sell. Now, it did work at the beginning, and then I realized really quickly as I was exiting from binary options that that figure was absolutely incorrect, and it didn't even mean much. But I was on the right track. I knew that getting out of binary options, that when most people are buying, I think I should actually be selling. I didn't know why. I just thought that maybe it's just the way things are, or maybe because there's a pullback, but I didn't have the understanding that I do now. Okay. So belief mechanisms. The other ones here is, I'm going to put this here, is I'm going to put this here. Believing the market controlled by retail trading. Okay. So fear, greed, and believing that the market is controlled by retail trading. Okay. These are the things. Now, unfortunately, there are still people that believe that the market is controlled by us, that our trading right now today is the reason why the market bounced up and down. It's got nothing to do with any banks or institutions. There's still people that trade like that. And unfortunately, when you do have results from stuff like trading trend lines or indicators, it can empower you to think that, you know, this is the way to trade. I'm settled here. I don't need to really move from this point. Okay. This is another thing. So this is why it's good to have this discussion with you before we get in there. So for you to really get in through the gate to understand exactly what's going on when it comes to institutional trading and stuff like that, I think one of the most important things that you're going to have to go and understand would be this point right here, which is how institutional money thinks, how it works, how it behaves, what it thinks of you. Okay, that's another thing. All right. Because one of the things that, you know, pride started to hit for me, not everybody it happens to, but it happened to me, that I really thought that I was the guy, you know, especially when I get a trade right. I really thought that the trend line is my trend line. I'm the one that created the trend almost, you know. So that's the truth. That was my story until I took losses. And then £4,153 later, I really got taught a lesson that I don't control any of the market. So when you see this Instagram videos of me flipping accounts, trust me, I've been through a very big journey to get to where I know how to control the markets. And oh, you can see I said the wrong word. Control the markets, or control myself in the markets is what I really want to say, or handle myself properly. I can't control the markets, obviously, but I mean to say that I can control myself and understand what to do. I can control by my position sizes and etc. So this is why I really want to go through this teaching, because I think it's so important for everyone, okay, to really get yourself involved in understanding what does it take to understand market monopoly. All right, so moving forward anyway, okay, coming back to market monopoly again. So these are some of the beliefs, part 3. For you to kind of get yourself, this is kind of like into the matrix when they give you the pill and then all of a sudden you see things in the world that you didn't necessarily see before because you've entered into a matrix. It does have that effect. It had that effect on me when I first started to learn and understand who controls the price and what controls the price really. It was like a matrix moment. Sometimes I'll still go back to my trend lines and my indicators sometimes, trying to understand and get the grasp of this stuff many, many years ago. So I think, you know, if it happens to you and you're not really too sure what is going on right now, please don't be worried. You get the picture as you keep on practicing. Okay. So as a recap, first of all, before I write number 3, all price points in the market are engineered by market participants with more money than all retail traders put together. Number 2, the market is never in any form of indecision. That means every price point you see, even if it's just a pip movement or a point movement, every single price point there has been pre-engineered by algorithmic technology. Okay, that's the most important thing. Number 3, all right, when it comes to the market is, or I'll say the price delivery to the market is controlled by algorithms. Okay, I'm going to call it algorithms. And the specific term here is called the black box algorithm. Now, yesterday, the day before, I went through complex linear regression. Okay. Black box algorithms. Now, what does a black box mean? A black box is a piece of information or a system that can take in information but doesn't divulge any information out, okay? Only to maybe give general information, but in terms of a system for taking in information is an absolutely fantastic piece of equipment. Now, there are black boxes within an aeroplane, and the reason why there's a black box within an aeroplane, as you've seen, unfortunately, with stuff in the past where airplanes go missing, when they find the black box is taking in information from every angle of the airplane, the electricity, the camera settings, the pilot settings, possibly even conversations, possibly of recordings, okay? The black box has its own backup generated power that can last for a while and its own memory storage. And I believe the black box information is actually fed to a secure server somewhere or secure servers around the world. And all the black box is designed to do is to take in information and, you know, depending on who's using a black box algorithm, use to better the experience of whatever they're providing, or to take in information for advantageous purposes. But that's what a black box algorithm is. Now, the market has black box algorithms, which have something called complex linear regression. Okay, what is complex linear regression? Is machine learning. Now, AI, I know we talk about it now because of stuff like ChatGPT, but AI has been there for a very long time. Okay, and this is what I'm going to put here: machine learning. Okay, or complex linear regression. So linear regression, or R, is a statistical term for you to be able to calculate metrics. Now, I'm not trying to do a science lesson here, so stick with me, please, and you follow through with what I'm saying. But complex linear regression or machine learning is the ability for the market algorithms to learn how traders behave, to take in information and not divulge information, okay? Hedge funds have black boxes. Their strategy is black boxed within very secretive systems to automate what they do so that they can produce results. So black boxes are everywhere in society. Okay, even in cars, they have black boxes that track people's usage of the car, the mileage. Okay, maybe not as serious, but black boxes are designed as they are to be black in the sense that things can go inside. But just like with a black hole, the reason why a black hole is black is because the light that's coming, or anything that's coming towards the black hole, gets sucked in, but nothing can come back out of it. Okay, not even light. So black holes, you can see a black box almost like a black hole. It's just one that can actually divulge information to the people who created it. Okay, so saying that and giving you that understanding, the black box algorithm that the market has, or what it uses, is to be able to learn how traders trade, to learn the behavioral patterns of traders. And this is an important key that I want you guys to have as a concept. It learns the behaviors of how retail traders trade. And what is the purpose of that? Is to learn where they put their stop losses, learn where they take trades so that they can stop them out. Now, if you notice with strategies that are based on patterns, and if you haven't had that happen yet, you will find out pretty soon, but don't worry, I can save you the time. I've tested out many, many different pattern strategies. And I can tell you this, when it comes to patterns, over time, a lot of strategies that you learn could work for one moment, for a period of time, maybe a year or two, and then they stop working. And they consistently get worse and worse. And it took me a long time to figure this out. And I really had to spend the time to understand how exactly, okay, price action works. What's going on? Why is it that a strategy that's supposed to be a solid strategy has stopped working? What is going on? Okay, these are the questions I had to ask myself, okay? And it's good questions to ask yourself, because if you have a strategy right now where it's not exactly working as you want, things are missing in terms of profitability is not at the ratio that you want, this is a good discussion to have. And maybe I'm going to answer your question today as to why exactly a strategy doesn't work over time. Okay, now I see more of you are coming onto the live, so welcome as you're coming on. Now you're probably going to hear my voice saying that a little bit later on, because I think there is a slight delay. But looking at the price action anyway, and coming back over here, let's have this discussion. So when it comes to price delivery mechanisms, let me bring back my little markings here. As a programmer, I can tell you that 90% of what goes on in the market is algorithmically controlled, and price is controlled by computers, not by human beings. Human beings, or very smart people within the institutional side of money and governmental money, program these robots to a very high level of accuracy to be able to carry out complex tasks. And their one design is to make money in the markets. Okay. Now, to put this into perspective, what does this mean? Now, what I'm teaching you is not a strategy, okay? Because you may ask, okay, so if you're teaching me this, then isn't this another strategy and it's going to stop working over time? It's a good question. No, it's not. The reason why is because this is not a strategy. What I'm teaching you is a system. I'm teaching you the system of how the market operates, okay? How price is delivered into the market, the 4 parts of price delivery. Now, in terms of creating a strategy is different from the system, okay? The system of how price comes from, as we looked at yesterday, from the interbank network, and then over to the liquidity providers, and then over to the brokerages, and then from the brokerages over to you. We looked at all the premiums and stuff. So if you haven't seen that video yesterday, please definitely check it out, yesterday's video. However, what I would say to you guys, coming back to this point, is that when it comes to algorithmic technology or algorithms in the market, I'm sure some of you follow me on Insta, so you know that I have built my own algorithm based on the principles of what I'm teaching you. When it comes to building any strategy around the market, or to trade, or to have a trading strategy, you need to have this as the foundation. What I'm teaching you in these 4 parts, again, is not a strategy, it's a system. The system of how price action behaves, the system of how money comes from central banks, from liquidity providers, from banks in the interbanking network to us. If you can understand this mechanism, and then on top of that, build a strategy that works for you, then your profitability will immediately increase. Because remember the concept we talked about, big fish and little fish. Before I write anything, institutional money will always have a leg up on retail traders, unfortunately, all right? They will always have a leg up. Why? Because they have access to the market with greater precision, a lot more information at faster speeds, and all the money in the world to be able to execute trades. For us as retail traders, our responsibility is not really to try to fight institutional money, because you never will be able to, but rather to beat them at their own game. As we will say, if you can't beat them, you have to join them, okay? So putting this into perspective now, okay, let's go back to where we are. So let me do this, and let's put this back where we are. All right. So when it comes to complex linear regression, over time, algorithms learn and better their ability to stop you out. Okay, so I'm gonna put this over here. Let me make this a bit smaller. So algorithms here, over time, they learn and better their ability to stop you out of positions, or to cause retail traders to lose money, specifically. Not just retail, stop you out, all right? So this is what happens over here. Now, if I put this in another color, maybe it might give you a better differentiation between all the writing, because I know it is a lot. Now, I'm stopping before I go to the technical side, because I really want this foundation to be there. Okay, guys? So pardon me if I'm talking a bit longer. I will get to the technical side of things so we can map this out in practicality. But you really do need to know this, guys. So I don't even want to miss out on the opportunity to show you what I'm talking about. All right. So anyway, coming back to the discussion here, and put this here. Algorithms learn how traders trade. So what they're looking at, what are they looking at? Well, these algorithms are learning the strategies of traders. Now, what you will notice, okay, and it doesn't mean that you can't have success with different strategies, but for me, I would say the opportunity of a lifetime that I've had is to be a loser first before I ever became a winner when it comes to trading. Before I ever started having these trades that, accurate trades that I've shown you guys and flipping accounts and doing withdrawals and whatever, I went through a long time of just being a loser in the market. But the loser side that I had especially really helped me to understand a lot of things about how trading works. So one of the things I used to do was to learn strategies, test them out for as long as I can, back test them and see how they work. And what I was noticing is that the further I go back in time, the better the strategy works. But the closer I go to the present time, the worse the strategy gets. And I wasn't changing anything. The metrics were the same. Everything was the same. And I was confused by that. Most of the strategies I learned that had anything to do with, and I'm going to list this here, patterns. Okay, anything that had to do with patterns. Okay, pattern-based strategies. Anything to do with pattern-based strategies, and I'm going to write it here, over time had a problem. They started off great, but then they ended up becoming sour at some point. So the profitability would start off maybe 70% win rate, then go down to 60, down to 50, then down to 40. And then after, it would just kind of level off at 50 or somewhere nearby. And I was so confused, like, if this is a strategy that's supposed to be something stable, how come the profitability always is better in the past, but worse in the present? What's going on? I really wanted to understand because it was an enigma to me. So the losing streak I had really helped me to see what exactly was happening so that I can, of course, overcome these issues and work out where to go next. So this is what happened, guys. When I found out that the algorithm of the market learned these pattern-based strategies and they're designed to cause retail traders to slowly be stocked out of their positions more and more until the strategy becomes redundant or just not profitable, or it still works, but not enough to bring profitability, then I had to take a step back, of course. It really shocked me. It really shocked me to find out this thing. And I don't know, it's kind of like I had a heartbreak moment, like, oh my God, the market really doesn't, I thought it was my friend. I thought it was there to help me to make money. We all make money together, but it was nothing of the sort, okay? It was the complete opposite, the complete absolute opposite. Now, why does this happen again? Because the machine algorithm is learning how you trade, is learning what you do, it's learning where the stop loss is. Remember, the black box algorithm is taking in information, but it's not divulging anything unless it's to the parties who created it, who designed it, to take in information and pass it back to them. They run many statistical calculations to eventually run you out of your position more and more. Okay, so what I'm teaching you here again, for the last time, I like repetition sometimes, is that this is not a strategy. This is actually a system of how the market works. And what you're going to do on top of this is build your strategy. So the first thing I do want to say is that if you are a pattern-based trader and you're having some success, but is not consistent, the reason why is not necessarily because you haven't found out what we'll call some honey in the market, but the problem is that the algorithm is learning what you do and finding out ways, if not in 6 months, in 12 months, 18 months, to eventually reduce your profitability. So now how do we overcome this? Well, this is why I titled the lesson Market Monopoly. It's a game of Monopoly. The market is designing itself and always setting itself up. Every single day that goes by in trading days, there are more and more situations designed to stop you out of your positions and to make sure you don't hit the targets you're supposed to hit. That is what the market is designed to do. Now, it's an unfortunate thing, but it is the truth. Okay, this is how the market is designed. Stop them out, get them out of their positions as much as possible. No matter the weather, whatever the weather, this is what we need to do. Okay, so I can say to you from experience that you have to make sure that you hang in there when it comes to understanding this, because it does take some time and it will, of course, take your ability to really focus and concentrate to go on. So now that I've laid this infrastructure, what do we do with market monopoly? Now, what is the monopoly here? Okay, I'm going to list out the monopoly here. What is market monopoly? What is market monopoly? So market monopoly, okay, in definition, is the purposeful manipulation of price to cause you and others, and I'm going to put other market participants to lose money. So let's put this here. I think I'll make this a bit smaller because it's getting a bit too big. Let's go for 10. All right. So what's the purpose of market monopoly, or what is it by definition? Is the purposeful manipulation of price to cause you and other market participants to lose money. Now, you have to understand that with market participants, I've been using the word a lot, but I haven't done a definition of it. And if you're wondering what market participants are, this is a lot more simpler to define, and I'll just give you a list over here. So let's make something up here. I'll just turn all the headings into blue so that you know the difference between the two. All right. And again, you can see I'm repeating a lot and taking my time because in my years of teaching, I realized that this part of the teaching is probably the most difficult to really teach when it's something new, in a sense that sometimes it takes a while for people to really grasp this. So I want to be kind to you as much as I can in every way to make sure that you get this, okay? Because if you get this, then you can build a whole future for yourself in the most fantastic way. And this is what I want for everyone. So moving forward now, let's go over to this part. So I'm going to do something here. Let's make a list. What is market participants? Participants. Now, without doing the categorization, I'm just going to list you who market participants are. Okay, very simple. Let's take this down to 8, or no, maybe just 10. Let's just make this, keep it black. So market participants, let's start with the first obvious one. We have governments. Okay, the governments are involved in the market. I mean, even though I was trading back then, I did know that the government probably uses Forex, but my understanding was maybe if they want to send currency to Europe, then they're going to do an exchange on the market, when little did I know it's a lot deeper than that. Okay, so we've got governments, we have central banks, okay, we have institutional banks or institutional banks, okay, we've got hedge funds over here, hedge funds. So you got hedge funds, institutional banks, central banks, governments. Okay, you've got Forex or money market exchanges. So money market exchange is literally exchanging currency from one to another. So that would be your bureau de change, as my fiance would say. Okay, those kind of places where you exchange money, one legal tender for another. So euros to dollars or dollars to pounds, etc. for going on holiday. All right, the next one you have over here is going to be hedge funds, insurance funds as well. Put that here. Insurance. I'll do mutual funds first on the left. So mutual funds. All right, we've got insurance companies as well. Insurance funds. And there's a lot bigger when it comes to insurance, because remember, through things like insurance companies, if they're going to insure you, now I read a little study that, you know, they hire a lot of what we call mathematicians, but there's a special type of mathematician called an actuarial scientist or actuarial mathematics, which is actuarial mathematics is taking maths into the public place to use it for the benefit of many different things. But one of the ways that actuarial science and actuarial mathematics is used is to create business models for insurance funds. Okay. So what they will do is they'll create insurance funds okay? And what they will do over there is, with that model that they make, and this is the one I read, that for every, I think for every claim that comes in, only 2% of the money, only 100%, or out of the 100% of money that goes into an insurance fund, only 2% comes back out in claims. So for that to happen, there's mathematics that go on to ensure that that money stays with the insurance fund. Now, with insurance companies, what do you think they're doing when they're holding onto your funds in insurance? Well, you're paying every month for car insurance, house insurance, and that money is just being paid to them, but nothing's gone wrong. You're sending them money, you're paying money to them, okay? And it's not like you make a claim every month, because not everything in your house is going to break every month, but it's just in case. So in essence, there's a fear pitch for you to protect your stuff. So with insurance, what does that money happen? What happens to that money? Well, that money is traded on the financial markets, in stocks, in different types of financial instruments, for the insurance firm to make a profit on that. Okay. And so this is why they are a participant in the market. Okay. So money market exchanges, okay, without having to say it, retail traders, okay, retail traders. All right. We also have brokerages as well. Okay. Brokerages. Okay. We have brokerages, we have exchanges as well. Okay. Financial, let's put financial exchanges. All right. So this is kind of like a list. There are a few more. Okay. We have hedge funds, small and large. Now, a large hedge fund is considered a fund that manages more than 100 million. Okay. That's what is considered to be a large hedge fund. Okay. A firm that controls more than 100 million. Okay. If it controls more than 100 million, then that's a hedge fund that's in the money, basically. Okay. So, bearing that in mind, you should all be looking to aspire to be large hedge fund people. Anyway, so now that you know what market participants are, all of these people who are in this market are also fighting against each other, even though to the left-hand side over here, this is what people would consider to be smart money. Even within these groups, some groups are for each other, some groups are against each other. Okay, so for example, Russia and China are not really friendly with the West because they have different ideologies of how to run their country. Okay, especially with China, who's, even though they call it democracy, is a lot more of a dictatorship style country, whereas in North Korea, for example, okay, now if you think about it, North Korea, which is not really friendly with the world at the moment, not trying to bring up any old wounds, but in reality, what I want to say in a sense is that not every government are friends with each other. So if there's a way that they can manipulate price against them to make money, then they will. So even though we're talking about us as the retail traders, again, I had to really think deeply about this, because of course retail traders are just part of the ocean of trading going on, $6 trillion plus of volume going on every day. However, when it comes to retail traders themselves, as much as there are a lot of traders, because we don't have the kind of money that can move the market, even if institutions liquidated all the retail traders, yes, they would make some money, but it still wouldn't be near enough to the targets that they probably have that they want to make. So it's not just retail traders are being manipulated. So the term that we spoke about on money, about the difference between intelligent money and uninformed money, or dumb money, smart money, people use different terminologies for this, okay, is that smart money is not necessarily just people who are retail traders. Smart money are people who understand this system, who use this system to their advantage. That's what really smart money is. So in essence, as a retail trader, you can be smart money, not because you have the pockets of smart money, but because you have the intelligence of smart money. Okay, so that's why I said to you on Monday, I don't like to really use that term smart or dumb, because I think it's a bit too I think it's a bit too demeaning as really is something to say. It's better to say uninformed and informed money, because there's been institutions that have really done things, if we were to quantify it as smart or dumb, it's really dumb. Okay, so don't get yourself caught up in that terminology too much. But what you do want to do is you want to be on the smart side of the market. Okay, the smart side, and that's where you want to reside. All right. Now, anyway, moving forward, now that you have this in your understanding, what is market monopoly? Well, the market monopoly is very simple. There are groups of people with more money than others, and their purpose is for price manipulation to cause you and other market participants, which you know now, to lose money. Now, the ways that they cause them to lose money can be in different things. I mean, if they do quick price changes, from money markets may suffer because they might be at a premium price that they bought an asset, or they call it assets, but just currency. And the price moves so quickly that they get maybe if they're trading in the market, their stops run, or maybe the price becomes a bit too expensive and unfavorable for them. So they're not getting a good rate. And that pushes up the price that they exchange it to others. You know, brokerages change the market, and we can go through A book and B book brokering or mixed house, which is another topic for another day. But when it comes to market participants, all of these institutions are for or against each other. So there's a lot of price action movement. It's not just you they're after, these rich groups of individuals called smart money. It's anyone that has money. Okay. So that's another thing that I do want to debunk to help you understand, where we are when it comes to our price action analysis and looking at the market. So this is the purpose. Now, how is it done? Okay. I'm going to give you the main things of how market monopoly is done. Number one is to cause, I'm going to use the term entice, okay, traders to be in a net wrong trend direction to the correct trend. All right. So I'm going to put this here. Let's change the color so that it can really stand out. Let's do this. Current. All right. So if I do this over here, as of such, I'm going to put here, let's do a color that, works really well. I'm going to go for blue. Okay. So if we were to do this and have a look at exactly why market monopoly happens, this is the first one: to entice traders to be in the net wrong direction to the current market trend direction. All right. Now, this enticement creates price patterns, not the same as pattern-based trading, but patterns in the sense of signatures. Okay. And that's why I prefer to use the term signatures, but I'm using patterns so that it can fit to everyone's picture of what they're looking for. So the enticement of traders into the net wrong direction to the correct trend is an enticement. Okay. So that's the first thing. Number two is to cause traders to be in the right direction late. Okay. Now, late, I'm going to put something here near the end of a major movement. Okay. I'm going to be more specific. Near the end phases of a major movement. Okay. So when it comes to the second part, this one is more techie. Now, all of these different things I'm giving to your market monopoly is what the price delivery mechanism is able to achieve, from accumulation, okay, to expansion or trends, to retracement, to all of the other, to reversal. All of those four patterns, or I'm using the word patterns again, but remember when I'm saying that, all of those four different methodologies or mechanisms within that structure is to create scenarios for this to happen. Okay. And I'll go down to the reason why it needs to happen. So we've got 1, 2, and 3. Now, what is the third one? Okay. To cause you to be in the right direction at the right time. Okay. Market monopoly is designed to cause you to be in the right direction at the right time, but with the wrong stop loss. Okay. Now this one, I added it in here because I could have left it at 2 just to give a little bit more of a different scenario or picture of what's going on, okay? So again, number 1, entice traders to be in the net wrong trend direction to the correct trend, market trend, okay? Number 2, to cause traders, and let's change this here, to be in the right direction, but late. So what will happen is that you do capture the right market direction. Let's say it's a buy, but let's just give a quick example, and I'm going to isolate this area here for a minute. Let's say this bullish area right here, or let's use a box right here. So what we'll do is that over here, this bullish trend right now, what would we do? What we'll say is that instead of getting in down here, which you can make the money from here to here, you're getting in over here. So you've got, I'm going to put this here. I'll use the term intelligent money. Let's put this over here at 8, and we'll call this green. So it's the intelligent money is hanging over here, but what intelligent money wants you to do is to get over here and buy here. And this is called unintelligent money or ignorant money. Now the term ignorant might hurt, but ignorance is not bliss, but it is the truth. It is ignorant money. So intelligent money gets in at the bottom here. Intelligent money wants ignorant money to buy here. Now, why is that? Because all these participants have the liquidity. If I buy over here, like our example yesterday, and I wanted to sell here, well, for me to sell over here, people need to be buying here. So I need to do whatever it takes to get people or entice people, which is the best terminology to use, to get into buying positions where I want to come out and sell my position. So then I can sell you my cheap price for an expensive price. And this is the design of market monopoly. And this doesn't just cover trading, because from the terminology I used, this could mean if, and I'm going to put this term here, liquidity providers here. I'll just add this in. Liquidity providers, like we looked at example yesterday. Providers. If liquidity providers wanted to send you or give you over here a connection here to the money market exchange, and they wanted to give liquidity providers are providing liquidity here, then if they're intelligent, then they want to get the currency at a discount price, okay, and sell them the price or the liquidity at a premium price, okay, because they make money. And this is how it is with trading, whether you trade Forex or you're looking at the market. This is all it's about. What the market is truly about, and I'm going to introduce a term now, is about premiums and discounts. Forex, as a trading, every financial asset is about buying at a discount, selling at a premium, or selling at a good price to somebody buying at a bad price, okay? So selling at a good price, which you want to call it a discount, but in a sense it is, because if it's a bad stock and you sell it for $600 instead of the real $200 it's supposed to be, you make 3 times more money than people who sold it at 200, right? So when it comes to the market, it's the same exact scenario over here. This is what happens when we're looking at how price action works. It works exactly in this way. We have a situation where the market is trying to get you to be in a position to buy at a premium price when they sell it to you at a discounted price that they got, okay? And this is why I really wanted to go through this teaching with you, because this is where it separates, again, the men from the boys or the women from the girls, okay? So that you don't say I'm being misogynistic, all right? But anyway, coming back to where we are right now, with all of this in mind, the last one is to cause you to be in the right direction, even at the right time, but with the wrong stop loss. So even if you did have some sort of understanding that you need to have a good stop loss because the market is not your friend, okay, their design, this machine learning algorithm is designed to continually do better to find out where your stop loss is. Now, the good news I want to tell you is that the way to win this game of absolute sounds like torture is to understand how these people think and to understand how they're going to think in the future. And there is a very good way to work that out. And it's called what I call thinking in money. Now, it doesn't mean to think dollar signs and pounds, but thinking about principles of business and how money works. Now, market monopoly, which is what we're going through today, this teaching has, of course, the theoretical side, but it also has a practical side. Now, what I'm going to deal with today, all right, is how it entices traders to be in the net wrong direction to the market direction, or causes the traders to be in the right direction, but too late. So to do that, I'm going to introduce a few things. Now, pay attention closely, and I'm going to go through these things in detail. So the first thing that we need to understand is these two words here. All right, number one, premium pricing. Okay. Second thing that we want to work out is number two, discount pricing. Now, the market, even though it's moving up and down, sideways, whatever, everything that's going on in the market is all about price. Okay, hence the term we say price action. What is the actions of the price? Okay, the second one we want to look at is discount pricing. Now, there is a way for you to calculate exactly what is premium pricing and discount pricing. And the third thing that you want to work out is true value. Okay, true value. These are the 3 points that I want you to go through and understand with me. All right. Now, the way to quantify this is to understand how liquidity flows. When the price is more bullish than bearish, then the price is going to go short. So when supply is greater than demand, then the price would be dropping. When demand is greater than supply, the price will be going long. Okay. So how do we turn this into something we can use for ourselves to be able to accurately chart price? Okay. Because at the end of the day, all of these nice and wonderful things I'm saying come down to the final point, which is to get in for a trade. All right, so let's do this. Now, the first thing you need to do is you need to identify trends. So one of the things that you really do need to work out is where swing highs and swing lows are. Now, I'm going to do a demonstration. All right, I like to use the daily time frame because it does work out to be really good. Okay, for things like this. And I guess in this case, I'll start with here. Now, the first thing you need to do to understand or even work out premium and discount pricing is to understand this terminology, which is called a parent swing. So parent swing. So if I go for steps to understanding institutional price action, all right, the first step that you need to do is that you're going to need to work out, okay, for me to understand this premium and discount pricing, which is, remember, and I'm going to put this here, smart or intelligent money is always buying at a discount and selling at a premium. So I'm going to put this here. Intelligent money is always buying at a discount and selling at a premium price. Okay. Always remember this. Intelligent money, I don't even think of intelligent, it's spelled intelligent. But intelligent money, okay, is always buying at a discount and selling at a premium. Now, who are they selling to? Okay, to sell to ignorant money. That's exactly what they want to do, to sell to ignorant money. So when it comes to price action here, what exactly is going on? So when the trend is moving from one direction to another, or when the price is moving from one direction to another, and I'm saying this based on the fact that you've watched the first two videos, when the price is going short or bearish, it means that the net liquidity on the market order book, which is algorithmically controlled, is bearish. It means that there's more selling than there is buying, which creates selling pressure, okay? That's where the term selling pressure comes from. Okay. Now, since you know this, let's move on to the next step now. So when the price is doing such a move, we can actually work out where the price started from and where it ended from. And this is where it comes to step number one. So step one is you need to find, okay, the parent swing. Okay. Now the parent swing, I know I'm coming with a lot of definitions, but I have to for you to understand this. Parent swing is the largest major move on your time frame of reference. I'll put time frame of analysis or referencing. All right. I'll just put for analysis to keep it short. Okay. Now, how do we find the parent swing? Okay. By definition, okay. So definition, it is the largest swing high to swing low movement, or vice versa. Now, what I'm going to do is I'm trying to save on space. So I'm saying vice versa, but let's do it here. The largest swing high to swing low movement would be a bearish trend, because what you're trying to do is you want to ascertain the trend direction first. Okay, now I know there are different methods to do it, but the simplest is to go down this method when you're looking at premium and discount pricing. So this will be a bearish trend. Okay. Now, if you're not too sure what a swing high, swing low is, I'm going to quickly do the definition in a moment. I'm going to draw out these candlesticks here, and we're going to switch around with them very quickly for you to understand what a swing high and a swing low is. Okay. Once I do that, then you should be good to go. All right. So I'm going to do these examples over here. I'm going to make it very easy so that you guys are with me. And then after we'll go from there. All right. Now, again, I'm taking my time with this one to teach this third chat part, because this is the hardest part to really grasp. And I want to make sure that you all grasp it really well. Okay. Might have to move this over there just for space reasons. Let's put that here. All right, let's put this out here. All right. Now, for a bullish trend, to get some information for you here, it's going to be the opposite. Is the largest swing low to swing high movement. Okay. And that would be a bullish trend. So from one extreme to the other, all right, now what is a swing high and swing low? So if I give a swing high demonstration first, swing high, what is it for those of you who may not know what that is? All right, a swing high by definition, I won't write this, all right, is when you're looking at swing high is when you have a candle, the candle in question is high, which the candles on either side do not close above the high. And after this candle closes, the direction or the color of the candle in this case goes from, in this case, bullish to bearish. All right, I'll say that again. So a swing high is when the high in question, which is this high over here, I'll just put an arrow to point it out to you. When this high right here, when the candles either side of the high suspected to be a swing high, none of the highs close above this high or the body of the candle. Secondly, after this high, swing high is formed, the next candle or the next candles after this high are in the opposite direction of the previous trend. So in this case, because I use blue for bullish, okay, it would look something like this. So if I picked over here and I said, all right, I'm going to grab blue here to represent blue, all right, and this is also going to be blue for now, right? Now, what this is that for you to know that is a swing high, the term swing means that the price is swinging from one pendulum of the market to the other, and there's only two. There's either bullish or bearish, or buying or selling. So what we have going on here is that this swing high is formed, and then the price, the pendulum of the direction of the market changes from bullish to bearish, okay? this high would be called a swing high, and of course would be used for many different purposes, which we'll go through in a moment, okay? But this is what a swing high and a swing low is. So I hope that fits the bill for you to understand what we're looking at, okay? Now, the swing low, as you're probably kind of figuring out, is the complete opposite to a swing high. So a swing low, same kind of mechanism of what you're looking for, is always the candle between two, so swing low over here. And what you're looking for is, in this case, because it's a swing low, the previous trend will be bearish. Okay, this candle will also be bearish in this position. Now, sometimes the candle in the middle can be either bullish or bearish. That's not the main thing. It's about the candles either side, its interaction with that candle that has the high. But for teaching demonstrations, I'm just making it as simple as possible over here. All right. So a swing low, by definition, is when the candles on either side of this low in question, they don't close beneath the low, which they don't. And then also after the low is formed here, the next candles after, okay, are in the opposite direction to the previous trend, which in this case is bearish. That is what we call a swing low. Okay. Now, in this case here, if we were trying to find out about a trend, what we could do is to find out, first of all, where's the highest swing high, swing low? Now, the great thing is that you can actually find this out by using your eye analysis, as I call it. So without having to do too much, you can really see a clear change in direction at simple points. So I'm going to do this here to kind of show you the simplicity of how it works. I'm going to spend about 10 more minutes on the technical side of during analysis, and then from there, I'll leave you guys till tomorrow and we'll continue. So over here, we can see that the price was at some sort of high point right here, and we can see that the price has dropped all the way down until this point here. We don't know what makes it special yet, but we just know that once the price got down here, it came all the way back up to here, and now it's come all the way back up here. So what we're going to do, we'll just put the highest point up here. Now, we've already found out swing highs and swing lows because these are the turning points if you want to put it in the market. All right, so if I just put some arrows here, here's a swing high, another swing high, right? Now, when you have multiple swing highs and swing lows, this is where you get the calculation of what the terminology of what you may have or may not have heard of higher highs and higher lows. Because in this case, this is the first high, and the high, the next one that has a major swing point is lower than the first high. So we have lower highs. Now, whenever the market is bearish, okay, this is the structure of how bearish trends look like, okay? Without having to do too much, the general movement of a bearish trend is this. Whereas with a bullish trend, the general structure of a bullish trend is this, okay? This is the structure, all right? So we have a moment where the price gives us a first thrust, which is what it's called. Then we have a retracement, which is one of the price delivery mechanisms. And then it has another thrust again, or an expansion. Okay, on the other side, we have the bullish side. The price pushes up and expands, retraces, then gathers its momentum and bam, pushes up again, bullish trend. Now, when you have this in mind, what's the next thing? So when you're looking for this institutional price action, you're actually looking for a parent swing. Why do you need a parent swing? Well, you need to see where the thrust of liquidity came in, because remember, the liquidity comes from them, from those group of people. So what you're going to need to identify is, okay, where the money in the market is obviously going to come from them. All right. Now, at that point, you should be looking for some sort of bullish or bearish trend going on. Now, how do we do this again? Now, when you're doing this, and this is the part where it gets important for you to listen to, is you're going to have to do a little bit of measuring, okay? And what you're going to do is you're going to take the high points. I'm using the D1 to really work out, okay, where is the parent swing? Because the parent swing, remember, has to be the largest swing, okay? The largest swing in terms of length. Now, what you can do if you're a meta trader, or you can just use your eyes really, because it will be pretty obvious most of the time. If we look at this high point, from this high point to the low point, I have MetaTrader, so it actually tells me how many pips or points. So it says 16,595 571 points, excuse me, which is 1,657 pips. All right. Now, this is the bearish side of the market, as we've just seen. Now, on the bullish side of things, if I grab this here, we have 1,561. Now, when you're looking at pips, remember, this is giving you points. If you use MetaTrader, this middle crosshair tool that I've just used, all right, with the zero, so 15610 or 15,610 is the number of points. Okay, so that's a tenth of a pip. So the pip is the fourth digit after the decimal point. So this is actually 1,561.63 pips. Now, just recapping quickly, because I've said many numbers, we see here from top to bottom, we have 1654, okay? And then from bottom to top, we have 1563.3.6, okay? So looking at that, obviously this trend right here is the bigger one, which means that in this market right now, from this range of 2022 to now, this is actually a bearish trend, okay? Now, we start to establish the parent swing. We're going to use a tool that you guys have heard of, but it's completely another reason why I was losing money, which is a Fibonacci tool. But the way we're going to program this Fibonacci tool is not the same way you've been taught to use it, okay? Fibonacci tool for analysis, okay? Now you're probably thinking, oh, you're just teaching me another retail trader pattern in a nice designed way. Well, pay attention to the end, you understand why. Now, why are we using the Fibonacci tool? Okay, now Fibonacci, the system he created, the 1 + 1 = 2, 2 + 1 = 3, 3 + 2 = 5, and etc. That Fibonacci pattern is a mathematical pattern that runs through all of history. Now, I'm not using the levels to be able to trade with per se, but what we're looking at here is a very important point of why I said to you that the market does two things, okay? The first one, and let me just get this correctly, and I'm going to pull this up from what we have here, all right, is the market is enticing traders to be in the net wrong direction to the correct market trend direction, or, and we'll deal with 3 tomorrow, cause traders to be in the right direction too late near the end phases of a major trend. In order for that to even, okay, one of the things that has to be done is to manipulate every tool. One of the biggest ones would be a Fibonacci. Okay, now how do we use this Fibonacci? Now, when it comes to the market, remember, intelligent money doesn't look at indicators or any tool. The only indicator is price, it's money, it's profit. Okay, that is the indicator. So if that's the indicator, we need to think like them. And how would that even begin? So what I'm going to do, my Fibonacci tool, tongue twister, my Fibonacci tool is already programmed. Okay. Now, first things first, if you've never used a Fibonacci, if you drag from top to bottom, if it's a bearish trend, the 100 should be at the top and the 0 should be at the bottom, okay? The 0 should be at the bottom. And let's just bring this over here. Now, I'm going to bring these all the way down here. In fact, you don't need these anymore, so I can delete it for now. And let's just delete all of this stuff here so that we can continue. So now that I've drawn this Fibonacci tool, you can see that my tool probably looks very different from the ones you open up on TradingView or in MetaTrader. The default MetaTrader one has a lot more levels. And if I had the chart that I could do this with, I don't think I can reset it, but the default Fibonacci has a few levels, okay? Now, I want to put the default levels in quickly so that you can see why I told you that the market is designed for you to be at a disadvantage. So the other levels that I have deleted that are missing are the 23.6 level, which we put as 0.236 or 23.6. And then we have another level, which is 382, which is the 38.2 level, okay? Now, there are Fibonacci extensions, which we don't need to go through because it's just an extension of the trend, all right? Now, EQ, which stands for equilibrium, I'm going to leave it there, but it's actually the 50% level, okay? Now, if I add these in here, okay, I'm going to leave all of these levels here. I'm going to explain to you something that you should understand about premium and discount. Now, first of all, whenever the market is in a trend, okay, bearish or bullish, institutional money is always trying to buy at a discount. And by definition, okay, discount pricing would be the 50% level or above when it's a bearish trend. Okay, so when it's a bearish trend, institutional money will do whatever it takes, which is using their financial weight, to drive prices above this equilibrium point to the cheapest discount that they can get in terms of market value. Institutions will never buy at a premium. They'll always buy at the cheapest discount available. Now, what does this mean? Now, as my teaching about retracements went, the deeper the retracement, the better. But that's as far as it went. I didn't understand why a deep retracement is important. Why doesn't the price maybe retrace at, I don't know, 42? Why is it these levels? Now, of course, these were created by Fibonacci. And don't get me wrong, many years ago, 2007, 8, Fibonacci tools worked like a treat. But remember, algorithmic price action is all designed to, over time, create situations that cause you to be a loser after all. That's the aim. So when it comes to institutional money, intelligent money always wants to buy at a discount and sell at a premium. So in this market here, selling above the 50% level means that if you're selling something, you're buying something. Now, if you sell Euro USD, what does that mean? It means that you're selling your euros in this case, which is the base currency, to buy US dollars, okay, which is the quote currency. And as the value of the euro versus the dollar drops, you know, your dollars will be gaining more strength because it costs less dollar. You get less dollars for the same amount of euros, okay? Now, on the other side of the market, when the market is bullish, the discount level would be below, okay, would be below the 50% level, okay? And that is for a bullish trend. Now, before we go anywhere, I just want to say this, that because of what I taught you about fractality, what I'm about to show you works on every time frame, because this is not to do with a strategy again, it's a system, it's mathematical. What we're looking at is how price delivery mechanisms come into the market. Yeah. So what we're going to do here is when it comes to the price action over here, okay, and this is important here, when you're looking at premium and discount, you want to think like them. You need to find out wherever you can, or where is the most likely place the price will sell. Now, because institutional money, governmental money, smart money, intelligent money drives the price, for you to get the best buying or selling opportunities, and think with me for a moment, what would that be? It will be when they find the cheapest price for themselves. So if it's selling, if they get the furthest price away from 50%, so somewhere in this range here, as deep as they can go before the price can't go any further, that's where they'll be looking to sell from, right? And if it was the opposite and we're in a buying situation, they'll be looking for the deepest place possible, okay, to go into, and this is important here, the deepest place possible in discount so that they can buy. Now, usually when I teach this with my students and people around the world, the buying side makes more sense than the selling side. And I know I've started with the selling because I tried to target the most difficult one first, but we will go through the buying side in a moment, okay? And these are the two steps you need. Now, what are you looking for? Now, we're not going through entries right now, but what we want to say is that from 50% above, the deeper the discount is, and there's a term I have here called OTE, which stands for optimal trade entry. The deeper the price goes towards the optimal or deeper discount, the more optimal the entry is. Now, 75% of the way is like a sweet spot. However, if the price decides to go further than that, that would be an even better discount, okay? So OTE, okay, optimal trade entry. It is a price point or a percentage point to be specific, but what it is really more of a range. The further the price goes even above here, as you can see in this scenario, the price went all the way up to if you were to do the maths, maybe like 95%, the cheaper the discount is. So whoever sold their euros to buy US dollars has had a really good discount against the rest of the market, okay? Because if you bought dollars here, 1 euro would have been 95 cents. But if you had sold your euros here, you would have had 1 euro would have given, for every euro you get, you would have got $1.10. So you're getting a lot more dollars over here than over here, which is pretty good. All right. So now that we've got this going on, let's take a look. Now, this is what we look for on the selling side. And because of time, I'm going to go to draw the bullish side of things, and then we'll continue for the final installment of this tomorrow. All right. So if I go over, let's pick out another pair at random. I'm just going to pick anything. I'm not going to pick a major pair, so it doesn't seem biased. I'm just going to pick anything. Let's go for, okay, euro. Okay, we've done a euro pair. CAD CHF. All right. Just a random pair, CAD CHF. All right. Now, instead of using the D1 time frame, I'm just going to pick the M15, okay? Because again, this works on every time frame. Now, again, looking at the M15 here, again, this is pretty obvious what the price looks like right now. It looks like an obvious bullish trend just looking for the last couple of days. Now, again, what are we looking for? So step one would be to find the major trend. Now, the key here is to remember that you can draw multiple of these because there are trends within trends, okay? Every time the price makes a movement and pulls back and then continues again, like here, we have a trend. So what I'm going to do, I'm going to isolate this incidence. This is not pre-planned at all. I didn't think about this. I'm teaching you from my head. I'm not doing any notes with you. I wanted to make it chart-based only. But if we look at CAD CHF, what are we looking for? Well, we can see there's an obvious swing low because the candles on either side don't close beneath. And after that, the price goes from bearish to bullish. Then over here, we see the price goes from bullish to bearish, okay? So we have our parent swing. So our parent swing is going to be this area over here, right? Right over here. Now, of course, this color is not the greatest. I usually use slate gray because it looks good, all right? This is the what we're looking at. So again, let's get the tool out. Now, this is a bullish movement here. So if you watch me closely with the mouse, what you're going to do is you're going to click here at the bottom and you're going to grab this all the way to the top. Now, I said I promised you I'm going to show you how retail traders get manipulated and what happens. Now, these two levels, 23.6 and 38.2 are retail trader Fibonacci levels. By default, when you open up any Fibonacci, these tools are here, okay? Now, I want you to see something in the market. Let's look at where money is flowing when it comes to institutional money, okay? Let's start from there. So if I start from this range right here, this is the downside. This is our major trend. Now, usually what you want to look for is a big burst of liquidity in one direction. So you can see here, price was down here. All of a sudden, in a few candles, we've had a big burst, and then we've had the retracement or the pullback. And then for whatever reason, the price decided it wants to come back right down here and then take off, okay? Now, this whole price mechanism delivery is institutional money at play or smart money at play, all right? What's going on here? Well, the initial thrust in the movement here caused some buying earlier on, okay? And then the price started to pull back down here. And when it's pulled back down here, what's happened? It shot back down to this area. Now you're wondering, why is it shot back down to the area and just gone over here? Now let's analyze this properly and see what's going on with this area. Now, first of all, we need to find our 50% level. And whilst I'm doing that, I still haven't forgotten, I'll show you why retail traders are manipulated. You'll see in a moment. So over here, okay, what's going on? So this is the 50% level right over here. Now the 50% level over here, anything beneath, so I'm going to draw a little range, or in fact, I'm just going to draw a little box, okay? Let's just draw a box here. So anything within this area, and I'm focusing on today because this is what happened literally today. So this is a trade you could have taken today if you understood this, all right? So where my blue line is, anything beneath there is going to be below the 50% level. And if it's below 50%, it's what? Discount. So I'm going to go over here and let's put blue over here. Now, anything that is above 50% is going to be premium. Now, it's premium for who? Well, it's premium for anyone, but it's specifically premium for the minds who are in charge of or have the liquidity to control the price. Okay. So over here, we can put this in another way. This is intelligent money friendly prices. So intelligent money, okay, will be happy to get in over here. Over here, anything above 50% would be unfriendly. Okay, why is it unfriendly? Because it's too expensive compared to them. They never want to buy at a premium, no matter because it's bad for business. Okay, it's bad for business. So we've got intelligent money and we've got unintelligent money. All right. Now, intelligent money wants you to buy anywhere in this region. And notice that you have these big pushes back here. And look at the first bounce, 23.6. And then it's pushed back over here for another movement here. We have another one. Look at the wick where the price went to, 38.2. Now, if you bought over here, what would have happened? Well, if you bought down over here as a retail trader, because this is the retail level here, and this is another retail level here, and you notice how accurate the wicks are, even as small as they are, the price seems to just bounce specifically in that area, almost like magic, right? So you would have probably seen this and said, okay, I'm going to place the buy trade, and you would have made money from here to here. But look at how fast the price pushes back down after doing this movement. Okay, so if you have bought this trade here, maybe put your stops to even, you would have quickly had money coming in, but immediately had money coming back out again, and you'll be close to zero. Then there's another moment where the price gives you another buy entry here, and it starts to go long, but not as far as the first movement, maybe about halfway, and now it's starting to wane away. And now the market is also starting to end. Now, tomorrow I'll be going through how time has something to do with this also. So if you were trading today, all right, out of the group of people here, who would have made the most money, intelligent or unintelligent money? Of course, it's intelligent money. Now, whenever the market does something like this is a preview for future attraction. What's going to happen is that most likely tomorrow, we can test this out. These two levels are going to be run down until the price gets down to 50%. Now, what is 50%? 50% is equilibrium. And equilibrium, okay, and hear me carefully, equilibrium is what is called by me true price value. So the true valuation for this exchange rate between the Canadian dollar and Swiss franc, according to this range here, sits right around here on the 50% level based on this movement here. Now, of course, I could actually do this and say, okay, I'm going to focus on, once this day ends, I can focus here. All right. Now look at this, just to give you a preview of tomorrow as well. Equilibrium is over here. And look at where the price is, where the old OTE, and maybe if you're not seeing this, I might have to put 2 Fibonacci's on. If I put both of these on right now, look at what's going on over here. Now it says value, it should say value, not Kanye, value. Okay. Now, if you do this, you can be rich like Kanye, and we could be rich together. Now, if you notice this, now I know there's a lot of numbers going on the side, but if we take it one by one, so this is the main trend we're looking at over here, right? From here to here, 50% is where this line is, right? As you can see. Now, if I delete this 50% and we look at the trend from top to bottom today, what do we see? The price has come back to this area. The 50% level is exactly the same as optimal trade entry. So this is the most optimal buy entry that you can go for. Now, inadvertently, I've given you a signal, because what's going to happen now, these people here who are trading retail, something else has happened. The price has formed the magic pattern trade that everyone knows, which is a trend line. Now, how would it take money from them tomorrow? Well, the people who have traded between now in the morning to the evening are most likely going to be UK and US market participants primarily. Now, UK and US, one thing we do have in common is that at least during maybe 3 to 4 o'clock, everybody will be getting ready, is either asleep or getting ready to sleep, depending on who it is. But our US brothers and sisters would be getting to sleep later than us, but because of time difference, roughly around the same time, everybody's looking to hit the hay. All right. Markets are closed also. So during the Asian session, which is going to be the open session from 9 o'clock until 6 in the morning, 6, 7 in the morning, what can happen while these traders are asleep and they're not looking at the charts and they're not managing their trades, the price can do what? Come back down here and do what? Stop them out. So the direction of these people are not wrong. But what's happened is that because they're not buying at discount prices or being intelligent money, they run the risk, okay, of being stopped out of their positions because they're right about the direction the price is supposed to go bullish or go long, but the timing of it is too late or too early, okay? So now this optimal trade entry, what would they do? Well, institutional money or smart money will do what? Bring the price back down to what? Fair value. Once the market is priced in at fair value, then what's going to happen? Or just beneath fair value, the price is going to do what? Take off. Now, we did a little teaching about supply and demand. So if you're a good student right now, you notice that where the price took off is the last bearish candle before the price changes direction, which is what? Another price engine. So if we put a trade together, I'm just giving you a trade signal. If the price does this, comes back to the fair market value into a demand order block, which is going to drive buy-in, then we should see a really brilliant move come in tomorrow for a buy opportunity. Okay. So this is how the first mechanism. Now, we've not gone anywhere yet. This is just the beginning of how price action works. Now, because of time, I'm going to stop the video here. But I wanted to make sure that you guys have enough time to take this in. I know this is a long one, but I want you guys to go through this as many times as possible. We'll be ending the last part of this series, part 4, tomorrow, to continue with our 4. So I hope you guys enjoyed this, and I'll catch you guys later.